Hi, I'm Neal McLaughlin for another episode of DIY Insurance Claims, your free resource for everything insurance claim related. Today I want to talk to you a little bit about the type of contract that an insurance policy is. An insurance policy is an unequal contract. It is not a value for value, equal footing contract that you have with your insurance carrier. It is unequal. And let me explain what I mean by that. The term that they use to describe that is aleatory. If it's aleatory, it means that it is not a straight contract. If you Google business law and contracts, you'll usually come up with a principle of a contract has to have certain elements. Those elements, for example, are an offer, an acceptance, and then consideration exchanged. In contracts, the consideration exchanged should be of very close to equal value. In an insurance policy, it is aleatory in that it is unequal. I'll give you an example. I can get usually a standard homeowner's policy for somewhere around $100 a month for an average home here in the United States. So for $1,200 for a year, a standard insurance policy period, 12 months, I will have given them $1,200. For that $1,200, the insurance company has agreed that if and when I have a covered peril loss, they will extend coverage to me and allow me to be brought back to pre-loss condition. It's an excellent service provided to the general public. And I just wanted you to be aware of that. That is a type of policy that you're entering into. Yes, if the events, the covered perils never happen, of course the insurance company will keep the premiums collected. They do so in order to be able to extend this coverage to the general public. Thank you very much. This has been Neal McLaughlin for another episode of DIY Insurance Claims. Have a great day.